Howdy, y'all. Welcome to Liberty Call. Today is Thursday, August 24th, 2023. You can see my buddy Jake back here patrolling the office, making sure there's no, uninvited guests here at the world headquarters of DSA Financial Group. So anyways, not the prettiest day in the markets, kind of the opposite of yesterday. Everything was up today. Everything's down. So, again, I think people are kind of trying to figure out where the market's headed. Is it going to continue on the upward trend we've been on for a couple of months, or is it going to continue or crash back down the other way? So who knows? I have no idea. I mean, I have my thoughts based upon the trends of the market, and oh gosh, the Astros are getting crushed right now. It's 11-1 Red Sox. Not a good way to spend my day game. So anyways, all right. Well, let's go ahead and get into the numbers in a minute. So if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could, give me some thumbs ups, likes, shares, subscribes, smash the notification bell so you know when I go live. And let's get into the numbers for today. All right. Dow Jones was down 1.08%, 373 points. Closed at 34,099. SP 500 down 1.36%, closed at 43.75. NASDAQ down 1.87, closed at 13,463. VIX was up 7.38% today. It's currently holding at 1716. Canada was down 0.52, Brazil down 1.02%, and Mexico down 0.99. Let's jump across the Atlantic. Germany was down 0.68. The UK was up 0.18. France down 0.44. Netherlands down 0.91. Not Italy. Spain up 0.1%. Italy down 0.57%. Switzerland flat at up 0.03%. And Portugal up 0.74%. In Russia, both exchanges were red again today. MOEX down 0.28. The RTSI down 0.73. And the overnights, starting out with the Nikkei in Japan, was up 0.72. Australia up 0.47. New Zealand flat at down 0.04. In China, the Shanghai was up 0.12%. The Shenzhen component up 1.02%. China A50 up 1.15%. DJ Shanghai up 0.36%. Hang Seng up 2.09%. And the Taiwan weighted came in up 0.85%. All right. So looks like Asia was the only part of the markets that seemed to survive most of the carnage of today, probably because they were asleep or everything. They're probably just trailing off from the good news from yesterday. And then they're going to wake up in a few hours and be like, what the hell happened? So, all right, let's get into the market recap. Wall Street declines as focus shifts to upcoming Powell speech. Yeah, everyone's on pins and needles right now, wondering what Powell is going to say. All right. On Thursday, U.S. stocks experienced a downturn with the NASDAQ dropping around 1% following significant gains earlier in the week. Investor anxiety ahead of the Federal Reserve Chair Jerome Powell's upcoming speech on Friday contributed to the cautious market sentiment. However, NVIDIA shares surged over 3%, reaching a record high after the company's robust forecast announcement driven by the demand for its AI chips. I like tortilla chips personally with some queso, but that's just me. I don't like the AI chips very much. They're not very tasty. Despite NVIDIA's positive performance, all major SP 500 sectors, including technology, witnessed losses, with the semiconductor index declining over 2%. Powell's speech, scheduled at the annual Central Bank Summit in Jackson Hole, Wyoming, is anticipated to influence market dynamics. Investors appear to be closely monitoring the Fed's actions, as indicated by Jake Dollarhide, CEO of Longbow Asset Management, who emphasized that market sentiment remains driven by the anticipation of Powell's speech. The stock market has rallied alongside NVIDIA's positive news, reinforcing this year's AI tech rally. Earlier data revealing ongoing strength in the U.S. job market could support the Fed's hawkish stance on prolonged higher interest rates. Treasury yields experienced a slight increase today. Investor attention was also drawn to remarks by Philadelphia Fed President Patrick Harker, who indicated that the Federal Reserve may need to maintain restrictive rates for a significant period. Retailer Dollar Tree experienced a 11.9% decline on its shares after projecting annual profits below expectations. The New York Stock Exchange saw a higher ratio of declining issues to advancing ones at a 2.61 to 1 ratio, while the NASDAQ, the ratio stood at 2.75 to 1 in favor of decliners. The SP 500 reported 10 new 52-week highs, 13 new lows, whereas NASDAQ Composite recorded 32 new highs and 195 new lows. All right. So, like I said, not the greatest news out there, but that's just the way it is right now. I mean, the Fed and our government has painted us into this corner, and there's really no other way to get out of it other than walking across the wet paint or standing around and waiting for it to dry. And it's a shame. I mean, these folks will, a couple of years from now, if the Republic manages to survive, they'll stand around want pats on the back for, look what we did. We helped save America. It's like, well, not quite. I mean, you created this problem by printing, $5 trillion? I forget the exact number, 5-6 trillion. It creates a lot of inflation when you increase the money supply by 40%. But what do I know? All right. Next up, jobs data. U.S. jobless claims fall. Core capital goods orders grow incrementally. All right. For the second consecutive week, the number of Americans filing new claims for unemployment benefits has declined, indicating a sustained tightness in the labor market despite the Federal Reserve's active interest rate increases. According to the Labor Department, let me stop there. I mean, because in theory, what the Fed is trying to do is raise rates, raising the rates up, so that it makes the cost of doing business or lending more expensive, so that businesses will have to reduce their spending on, capital goods, things like that. Employment. And so which would push down the number of people in the labor pool or in the employed pool. But I mean, it seems kind of weird to, go, we're going to harm everybody in the hopes of less people working to reduce inflation, when in the first place, you could just not print all that money. All right, where was I? According to the Labor Department, initial claims for state unemployment benefits dropped by 10,000 to a seasonally adjusted 230,000 in the week ending August 19th. This figure came in better than the forecasted 240,000 claims by economists pulled by Reuters. The previous week's level was revised slightly higher by 1,000 claims. While some experts had predicted a downturn in the labor market following the Fed's rate hike since March of 22, particularly in the aftermath of the collapse of the yellow trucking company with around 30,000 workers, the expected negative impact has yet to materialize. The Labor Department is defying expectations by retaining strength as employers hold on to workers due to difficulties in finding labor during the COVID-19 pandemic. I don't know if COVID had anything to do with that. I just think younger workers are lazy. The resilience in the labor market, coupled with the deceleration in inflation, has generated optimism that the economy might avoid a recession. Continuing claims, which represent the number of people receiving benefits after an initial week of aid, serve as a proxy for hiring, decreased by 9,000 to 1.702 million during the week that ended August 12th. This as revealed by the claims report. While indicating that laid-off workers are experiencing shorter unemployment spells, these continuing claims remain historically low. A separate Commerce Department report highlighted a modest increase in new orders for key U.S. manufactured capital goods in July, suggesting sustained business spending on equipment following the rebound in the second quarter. While orders for non-defense capital goods, excluding aircraft, inched up by 0.1%, June's figure was revised from a 0.1% increase to a 0.4% decrease. Shipments of core capital goods dipped 0.2% in July and 0.1% in June, with these figures influencing the calculation of equipment spending in the GDP measurement. The resilience of the job market and a reduction in inflation have led many economists to revise their GDP forecasts upward for the remainder of 23 and into 24. We shall see. I mean, for all these people who are in the finance world, the fact that they don't see, just carnage out in the future, I just don't get it. So, I mean, they get on TV and talk a good game. Oh, everything's fine. It's nice. Oh, well. All right. Last article comes from Mises Wire. It's titled "The Fed Harming the Economy for Over a Century," written by John Wolfenbarger. Summary up here. All right. Since its inception in 1913, the Federal Reserve has held the remarkable authority to conjure money out of thin air, a privilege denied to ordinary citizens. It's called counterfeiting if you and I do it. This establishment also shoulders the significant responsibility of maintaining maximum employment, price stability, and low interest rates. However, a retrospective analysis shows that their track record in achieving these goals has been far from stellar. Throughout its existence, the Fed has been associated with numerous economic upheavals. Price inflation. The Fed played a role in over 20% price inflation during World War I. It was also implicated in the early 1920s depression, resulting in over 15% price deflation. The Great Depression. The 1930s saw the Great Depression marked by 25% unemployment and a GDP drop exceeding 10%. Stagflation. The 1970s witnessed stagflation characterized by double-digit inflation and higher interest rates. Housing bubble, the early 2000s, so a housing bubble fueled by the Fed and our government. The Great Recession, the 2008-2009 period marked a Great Recession. And COVID response. In the response to the pandemic, the Fed increased the money supply by 40%. We already talked about that. Despite its intent to stabilize the business cycle and foster economic prosperity, the Fed's impact has not always been beneficial. The analysis reveals 5 key ways the Fed has worsened the economy compared to the scenarios without its influence. Unemployment. Before the Fed, unemployment remained low due to a lack of legal restrictions on voluntary work transactions. Post-Fed, unemployment reached unprecedented levels during the Great Depression and subsequent crises. Inflation. Inflation, almost non-existent before the Fed, surged significantly afterwards. This drastic inflation eroded the dollar's value by 97% since 1913. Interest rates. Long-term interest rates were less volatile before the Fed. However, aggressive money creation led to high levels of interest in the early 1980s. Economic growth. Economic growth was higher before the Fed's establishment, suggesting its interventions have curtailed prosperity. And deficits and debt. Post-Fed, budget deficits and debt surged. Deficits have been consistently high, leading to debt levels as high as 112% of GDP during World War II. It's higher today, actually. The conclusion drawn is that the Fed's central planning, akin to that of the Soviet Union, has proven ineffective. Rather than fostering economic stability, its interventions have generally generated instability and wasteful resource allocation. Critics contend that the Fed was established to serve banks, allowing fractional reserve banks to create money and be bailed out when in trouble. To attain true economic stability, some advocate for a system with 100% backed reserves, eliminating concerns over bank runs, supply fluctuations, inflation, and boom and bust cycles. This, they argue, would lead to unprecedented economic prosperity, stability, and obviating the need for central economic planning. And if you want to read a good book, read The Creature from Jekyll Island. It is a really good synopsis of the last 100 years of the Fed and all the carnage that they've caused during that time. So anyways, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.